Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. Yields cooled off once again yesterday, but here's an interesting fact for you. The yield premium on the S&P 500 has completely disappeared, meaning the US 10-year yield topped the US stocks earning yield for the first time since 2002. Now, markets will be closely watching out for the data from the US, but for us in India, we will be closely looking at the RBI's MPC outcome. Good morning, JK. What do you expect out of the MPC decision, and what would be the key driving points for the market?
Good morning, Swaraj. Yes, the MPC rate decision will be out at 10 a.m. today, and the expectations are for another hawkish pause by RBI, and that is par for the course. With the domestic inflation well above upper limit of RBI's mandated band and global bond yields rising, it's difficult to see RBI doing anything different. And one would, of course, be interested to see their forecast on inflation in the background of higher global crude prices and growth. Though I do not expect a major change from the previous forecast of inflation for the full year at 5.1% and GDP at 6.5%. With core inflation easing everywhere and supply side price pressures easing also, barring crude oil, of course, we feel rate cycle in India may also be near the peak or maybe already seen the peak. But we do not expect anything in the policy to influence the rupee movements. In fact, speaking of the rupee, INR traded in its tightest weekly range of 6 paise or 0.07% in this week, which is, in fact, tighter than the Chinese yuan offshore, where the Chinese golden holidays have contained the actions. So RBI actions have been the only reason it has been held below 83.29 all-time low, with speculators driven away from the market, and no reaction has been seen to the volatility in Asian currencies and the risk-averse sentiment. There is little hope that it will change with the two key events ahead today, the RBI policy and the US non-farm payrolls, and any hopes of elevated volatility in the rupee will only be dependent on the central bank. Of course, in the global markets, we had relative calmness across sectors, particularly the bond yields for longer tenor that moved in a narrower 7 basis point range. With yields moving near the crucial 5% mark, it would be, we would be cautious about assuming further up move immediately, although the trend has not changed, and expect some consolidation unless today's non-farm payrolls create a fresh stir. Taking cues from yields, even stocks were relatively quiet, awaiting fresh direction. Only currencies saw some pairing back of dollar longs, but still well below their broken strong supports. Yesterday's further clues on job markets have kept me quite confused. Both weekly jobless claims and monthly challenger job cuts data came on the lower side, which means tighter labor market, and added to the mixed view on the jobs market after the stronger JOLTS data, but much weaker ADP numbers. So I would prefer to look at the non-farm payrolls definitely, as everyone else would be, and that is expected to be lower than last month's number at 1,70,000, and unemployment rate to ease slightly to 3.7%. The crucial wage inflation is expected to be flat on YOY basis, while MOM 0.1% increase is expected. If they come as predicted, it would not change the current expectation or stance of Fed. Of course, both Euro and GBP moved leg higher, mainly on short covering and digesting the divergent views of their respective policymakers on future course of rates. It's not different in the US, where members' tone has been mixed about the peak policy rate. Interestingly, the San Francisco Fed President Mary Daly stated that the recent surge in term yields replicates rate hikes. So the yield surge has actually done the job for Fed. That's what she means, and maybe takes the 2023 rate hike off the table, but she won't rule out action in 2024 if the data warrants. Surely the recent surge in yield has tightened the financial conditions. More than one ECB member hinted that the rate hike at the last ECB meeting was the last one, and analysts speculated whether also on the Japan, analysts speculated earlier this week that Japanese authorities might have intervened to support the currency, but the Japanese money market data showed on Wednesday that it was unlikely. The only real good news for policymakers as well as investors is that the oil prices extended Wednesday sharp losses as the demand outlook remained uncertain and market faces a monetary policy outlook. We're also looking at the break higher in the natural gas prices above $3, and that's actually above a strong technical resistance level as well. Of course, this has a implication for the Eurozone economy, which last year struggled with natural gas prices ruling at sky highs, but this year they are apparently well prepared to meet, and the storages have been well. So all in all, current sudden calmness on the markets, but I think we can have some shake-up after particularly today's non-farm payroll, although I expect the MPC decision to be a non-event. Thank you.
Thank you, JK. And of course, the attention would be on MPC and the US non-farm payrolls. What we are expecting out of MPC is a hawkish pause. Domestic inflation is above the mandated inflation band. Forecasts on inflation would be keenly watched, taking into account the higher oil prices that are going on. And when it comes to rupee, we traded in one of its tightest weekly range. The US non-farm payroll will be an important global data point. Markets will be tracking. Numbers as expected might not lead to a change in stance for the Fed. That's it from us today. Thanks for listening. Have a very good weekend. Tune in on Monday as we discuss the latest in the financial markets and the reaction from the non-farm payrolls. Thanks for listening.